What up, everyone? Spencer Israel here with another edition of the ETF Show, the show with the most creative name on the internet, the World Wide Web, the net, whatever you want to call it. This is a show about ETFs, but I just want to hold that thought for just a second here and just look at what's going on in the market today, because it is a crazy day. I know we say that a lot. That we probably overuse that term. You know, it's crazy day, but today really is a crazy day. Look no further than GameStop. What the hell is going on here? What's going on here? Let's zoom in. 1 minute chart. 1 minute chart. What is this? Does anyone know why? Can anyone in chat tell me what happened today? Why this happened? Does anyone know? I've been trying to find out for the last couple hours. I don't know. It's insane. Okay? What is going on here? Did we ever get confirmation on Robinhood restricting selling again or buying again? Because I don't understand what happened today. You know, 1 minute it's at 330. A few halts later, it's cut in half. Right? At 12:20, it was 340. 20 minutes later, it was half that. What is going on? Seriously. Who is the SEC? All right, I know this is an ETF show. We'll get to the ETFs, but SEC, what are you guys doing over there? What are you doing over there? Somebody. I'm freaking out, Luke. I don't understand the GameStop thing. Somebody explain to me. Can some regulator come in and just bring order to the chaos and explain to us what's going on here and why? This is ridiculous. Luke, what's up? All right, Luke's just sitting behind me. I mean, the squeeze is getting squozed. Yeah, I mean, look, here, let's zoom out, all right? Let's go to a 15-minute chart. It had been going higher as it was wont to do. There's nothing wrong with GameStop going, you know, obviously the stock has been trading in crazy town for a hot minute here, but there's nothing really wrong with the stock going back up to 300. It's not like it went there one day. This is like relatively normal trading. And what I mean by normal is like there were no trading halts, no volatility halts. It wasn't doing insane stuff after hours. It was just going up. And then today we get this ridiculous thing. What is this? I don't even know what this is. This is not how stocks trade. See, this right here, this kind of BS, this is why people like Dennis and Kramer were like furious, right? The first go around. If I just go to it daily. When this was going down, this is why they were all pissed, because that's not how markets work, right? This isn't how it's supposed to work. You know, people joke all the time about efficient market hypothesis. How efficient is the market really? It's not that efficient. It is efficient. It's not efficient. Regardless, you at least expect stocks to trade a certain way and to like obey the laws of physics, right? And so this was like a breakdown in the market right here, and that's why they were all pissed, because it was just a breakdown in market mechanics, the supply demand nature of the stock. But eventually, you know, it works itself out, forming a nice little base, starts going up. Again, there's nothing wrong with GameStop going up, but what happened today is just ridiculous. Yeah, Jonas. It's a clown market. I don't get it. Seriously, it makes no sense to go from 330 to 170 in 20 minutes and then gain half of it back. What the hell? I'm just as gobsmacked as all you. I really am. I do not understand. Also, I'm watching this Roblox ETF IPO today. Let's go to 1 minute chart. God, this thing didn't open until just recently. Like 40 minutes ago? It's late. The latest I can remember was Uber. Uber took a long time. I think that was like 2 o'clock. But, you know, this was the first, to my knowledge, the first direct listing on the NYSE. Oh, no, I'm sorry. I take that back. No, it's not. I don't know why I thought Roblox was on the NASDAQ. I said that this morning, and I take that back. I don't know where I heard that, but that was obviously wrong. Roblox is on the NYSE. They've done this before. Direct listings generally just take a while because there's no underwriter out there building a book. So what they always say about these things is watch for first day volatility or in the first few days, because there's no institutional support coming in. Like if Roblox were to all of a sudden go down to like 50, right, or 45, there would be no big banks coming in to defend the stock. Luke, what's up? No, they can't hear you, so I don't know why you're talking to me when I'm doing. Luke says Ryan Cohen can come in and defend the stock. It's a great business. It's a great business. It's an amazing technology, but the fact that their valuation was $2.5 billion a year and a half ago, and now it's like 40 times that? I don't know. I don't know. All right. So let me get back to what I was thinking about before the game. The GameStop thing is just insane. Chat. Robin was asking if the Mozzie options show is on hiatus for now, but we are testing a new options show making its debut on Friday. Options Explained with Wealth Builders HQ. That'll be Friday at 2:00. For now, it's really just me. I'm going to hang out with you, and then I've got you want to do some more ETFs. All right. Jake saying the Stimmy just got passed. Stimmy got passed. Stimmy got passed. Show me the money! Yes, give me that money. Give me that money, everyone. All right, back with what I was doing. So I have mentioned on Pre-Market Prayer for the past couple of days that I am looking to buy a new ETF. I am in the market for an infrastructure-y type play. All right, and I had a bunch of people send me a bunch of stocks. Someone sent me, said you should buy your Steel, you should buy Cleveland Cliffs, you should. Someone sent me like a list of 20 stocks. I don't want to buy one company, right? That's just not really my style. One, because I'm not confident in my own abilities to pick a winner, and two, because honestly, I'm lazy, right? I'm lazy. That's the God's honest truth. I am lazy. I don't want to have to dig through financial statements and earnings reports and try to justify to myself, right? So if people ask me, why'd you buy this stock? I have at least a semi-coherent defense explanation. I don't want to have to do all that. I'm lazy. That's why I like ETFs. I'm lazy, right? Here, what do I say at the start of every show, right? Why do I like ETFs so much, right? There's a few reasons, 5 reasons. They're diversified. They're tax efficient. Low fees, actively traded, transparent, right? And I'm lazy. And if you're lazy, ETFs are like the best. Jason, get out of here. Jason, I'm blocking you. Jason, get out. No, get out of my chat. So okay. So I want to buy some sort of infrastructure industrial play. And I'm lazy, and I don't want to have to do all this due diligence, and I don't want to have to go through digging through conference calls and discounted cash flow and do all these things. Let me just find an ETF. Let me just find an ETF that I want to buy. Okay, so how do I do that? A couple things. First, I went to let me pull up my screen here, and. All right, so I go to a site that I like called etfdb.com, and I look for. First, I thought infrastructure, right? Infrastructure. That's what I want. I want to make a play on the U.S. infrastructure. 2 reasons. One, if I pull up my screen here, I'll show you all the ETFs that I own. Okay. Just in alphabetical order by ticker. So with the exception of the bottom 2, right? The 2 Vanguard ones, I got a lot of tech, right? Look at that. Cyber, tech, ESPO, tech, 5G, tech, IBB, half tech, half healthcare, KWeb, tech, SPAC. That's who am I kidding? Basically tech. The Pacer benchmark is is like a tech REIT, right? Space. I got a lot of tech, a lot of shiny objects in there. And I want to get away from that. And again, I'm pretty fully invested at the moment, so want to get away from that. That's one reason. The other reason is I'm confident that at some point during this administration, they're going to start throwing money at U.S. infrastructure, just throwing money at bridges and roads and dams. Biden's talked about that. Harris has talked about that. Oh, I do own ARKK. Thank you, GGG. I don't know why I didn't put it on. Why is it not on my list? I own ARKW. That was horribly silly of me. Thank you. ARKW is on there. That was an oversight on my part. My fault. ARKW is the highest flyer, and I'm not going to sell that unless it falls to like, I don't know, like 80 or something. But I'm staying in ARKW for a while. So yeah, so two reasons. One, I'm heavily overweight tech, and two, I'm confident that they're going to start throwing money. They, meaning the administration, are going to start throwing money on towards infrastructure. YOLO is missing. I mean, the way I see it, I've got some YOLO plays. Like this SPAC ETF is kind of a YOLO play. I don't really know too much about that, to be honest with you. And so I just want to get out of this. I just want to get out of this overweight tech thing. Right? So, okay. Infrastructure. That's what I want. So the first thing I did is I went to etfdb.com and I looked at some infrastructure ETFs. And here is what I found. Where's the page I want to? Actually, let's go back to Benzinga Pro. I found 4 ETFs that were of interest to me. These 4. Okay. Let me zoom out. Okay. IGF, IFRA, GII, and PAVE. Okay. IGF is an iShares global infrastructure fund. PAVE is a U.S. infrastructure. IFRA is U.S. infrastructure. And then GII is global. And look at that, right? Look at the clear difference in performance, right? The bottom 2 right there are global. The top 2 are U.S. And that's what I want. I want U.S. Okay. So forget these other 2. I want U.S. I want PAVE or IFRA. Or so I thought. Right. That's what I thought. Then hop in here. This is a neat little tool on ETFDB where you can just compare head to head. Again, this is how I start. I just searched for a keyword, infrastructure. That's what I want, infrastructure. Okay. But I start looking at these names, and wait a second. AEP, utilities, right? I see John Deere on there. That's cool. But I'm seeing some utilities. I don't know. Dominion. I don't know if that's what I want necessarily. Okay. And then just as a confirmation, IFRA is more than a third of the fund is in utilities. That's not really what I want. I want more like Caterpillar, right? That's what I want. So what I'm looking for, it turns out, is industrial, not infrastructure. So let's go over to this other Benzinga Pro chart. Don't know why it looks funky. There we go. 7 or 8 or so industrial. These are like the largest industrial ETFs. I just kind of went through and compiled a list in no particular order. You can see the performance here going back 3 years. Okay, industrial. This is really what I'm after. Not so much the infrastructure stuff, the industrial stuff. So let's go back to ETFDB. And where is my, here we go, industrials. Okay. And so, again, I'm just going through how I would do some research, how I would pick a fund, right? So at first I thought I wanted like an infrastructure fund, but I don't want to own utilities. I want to own stocks like John Deere, which was in that one, but more of that, right? I just don't want to have that exposure to utilities right now. So let's just start with the largest one, okay? XLI. And let's just see. I don't know what's in this thing. I have no idea. Let's take a look. Okay, super cheap, expense ratio, right? Okay, as long as it's not alarmingly high, I don't really look at that too much. As long as it's not like 1%, that'd be insane. But it's not. Okay, industrials, large cap, US, looking good. Well, what about? You see, it's pretty cheap compared to its peers. What about? What does it got? What does it got? Let's see. All right, this is more like it. That's more what I wanted, right? Honeywell, GE, which had news today. Caterpillar, that's what I want. Boeing, John Deere. This is what I'm after, right? These types of stock. That's what I want. See some more charts here. There we go. Where is it? See, I don't even see utilities on here. That's exactly what I didn't want, right? So manufacturing. That's what I'm talking about. Transportation. Again, because it is my opinion that during the next 3.5, 4 years, at least during Biden's first term, that they're going to throw money at infrastructure and try to fix bridges and all the stuff that's broken, right? It's my opinion, and I want to play that. Okay. Warren Lobb is saying, check out Moo. That's agriculture. That's like the largest ag ETF, I believe. Seeing everyone's dropping in this. See, this is great. This is great. You guys are dropping your own tickers. Okay. Brandy says she has some PAVE. Awesome. Awesome. Okay. I got to write this stuff down. URA. And I don't know all these off the top of my head. You just got to look it up. URA. What else we got? Oh my goodness. FIDU is on this list. FIDU. Let's go to that next. That's from Fidelity, right? Let's go to FIDU next. And let's see what else was MSOS JG. It's a cannabis ETF. That's the one that I don't own. I own like 40% of that fund via the four largest holdings. But if you go watch last week's show, I replayed an interview with, or not interview, presentation with the Dan Aarons from Advisor Shares about MSOS. So I recommend that. What else? Before I go back to this from chat. URA, I wrote that down. FIDU. Warren Lobb says he likes PAVE. Okay, let's go back to this Fidelity thing. Again, expense ratio, as long as it doesn't freak me out, then I'm going to just go right over it. It's very cheap. It's Fidelity. A lot of them are pretty cheap. So again, industrials, large cap, it's all the same. It's all the same. Let's take a look at the holdings. What does it own? Okay, a lot of the same stuff. So the top 10 is pretty much the same, right? So let's actually do this. We got FIDU and we got XLI, right? So let's go to this tool. FIDU, XLI. Let's just see. I do look at this number. Some people might not care how large an ETF is. I do care. It's mostly just a signal to me that, hey, a lot of other people, either a lot of people are in this or they're not, right? It's a popularity contest in a way. I won't buy any fund that's got like a ridiculously low AUM, right? And when I say ridiculous, I'm talking like, 50 million. That's really small. And because at that point, you just, maybe it's a newer ETF. You don't know. Maybe it doesn't have the performance history. You just maybe it stinks. I mean, maybe it just sucks, right? So I tend to avoid like the really small AUMs. These are both like that's not a small number. So I'm not going to pick XLI only because it's got more AUM. That'd be silly. But I do sort of keep one eye on that number. Let's keep going here. Look at the holdings. Okay. Again, I'm doing this for the first. I've never looked at this until just now. I'm doing this with you for the first time. So FIDU is a little bit more diversified, right? Actually, I should say a lot more. It's got a lot more holdings, but I'm looking at this on the second row. It's got a much smaller percentage of its assets in the top 10. Okay, so it's more equally weighted, right? A lot more holdings. Look at that. That is true diversification. 339 stocks for 75. That is just true diversification right there. So FIDU, much more diversified. You can see it right here because the highest weighting in XLI is 5% compared to just 3.9%. But it's the same stocks. Is that because it's the same index? Oh my God. These track the same index. Am I an idiot? I might be an idiot. These might track the same index. Oh man. All right. If they do, that would be that'd be really silly. Just look at some performance data. I'm doing performance, doing it right now, Tiago. Let's just see. You know, I don't like this. Let's just go to chart. So FIDU versus XLI. This is going back 3 years. FIDU. So okay. So FIDU is beating it by 6 percentage points, right? That's not that big a deal over the last 3 years. If we zoom in, FIDU is just a little bit better. Just a little bit better. Not enough to, like, you know, destroy XLI or anything. But if you want to chase performance, you'd probably go with FIDU. Let's look at this PSCI. What's going on there? And reminder, I've got Jamie Wise coming on in around 15 minutes from Buzz Indexes. What did I say? PSCI? Oh, small caps. Hey, there's all that research that says small caps outperform, right? In the long term. Yeah. All right. A lot different holdings in the top 15. More expensive. More not enough to kill me or anything. It's not going to kill you, but more expensive. What about what about the divvy? All right, better than average for its peers, for industrial ETFs, better than average, and a little more expensive as far as valuation, but it's not. We're not talking RGI, which has a PE 221. That'd be insane. So okay, let's look at let's go back to its holdings. We could download the full list. I don't really want to do that right now, but it's a small cap. Okay, so now we know, and we know that small. It's not a surprise to see this at the top of the list. Now that I know what it is, right? Small cap industrial fund. Okay, so small caps outperform. This is just general rule of thumb. Small caps outperform. Wouldn't shock me to see PRN as a small cap too. Do y'all have a favorite? I'm just curious. So RGI, see, we just said RGI has like a really, really, really high PE ratio compared to its peers. So RGI is probably off my list. I don't really want to pay a crazy valuation for this thing. So we've got a few more here. IYJ, that's like also one of the largest, right? Let's go back to our list. IYJ, yeah. The iShares, U.S. Industrials. Again, so the thing is, these are all kind of basically the same. They do more or less the same thing. The biggest difference really is going to be like, is it large cap? Is it small cap? Is it U.S.? Is it global? But everything on this list is passive. It's rules-based. What the hell? I just got a weird Google alert. All right. It's passive. It's rules-based. Rebalances like quarterly. They all pretty much pay similar dividends, charge similar expense ratios. If you're deciding between State Street and Vanguard and iShares, the three largest issuers, it's kind of like splitting hairs, right? I honestly, chasing performance going off performance is not the worst idea, because the rest of the funds are going to be very similar. So that's just like a quick thing. I'm not done yet, but that's just a quick thing on how I would go about just doing some very initial, very cursory research on an ETF. And remember, the great thing about about ETFs, or one of the great things about ETFs, is they're pretty simple to understand, right? You just got to look at what it holds. What does it own? You don't have to go digging through financial statements. Unless you want to understand, the companies that make up the largest part of the fund. But you don't have to do that. You don't have to know how to do a discounted cash flow analysis to understand these things. You're just going to know what you want to own, and then find a fund that works for you, right? Yeah, Dino, IYT, right? What's IYT? That's transportation. Yeah. So again, this is just cursory analysis. I'm going to do more, maybe I'll do this on the show on Friday, and just go through the rest of these and just see what they own and come to a decision. But again, this is just very basic how I would start my research. Right, you want to look at your expense ratio, your holdings, your top holdings. What percent of the top 10 is what percent of the fund is concentrated in the top 10 concentration. And yeah, that's that. It really is that simple. It does not have to be complicated. It's as simple as complicated as you want to make it. Okay, I choose to make it simple. Am I doing the most amount of research? No, I'm not. Okay. Swan Moon, do you believe in the concept of buying these as cheaply as possible? That's a good question. So I assume you mean like timing my trade, right? So like hypothetically, if I wanted to, let's get rid of all these because I don't want to buy any utilities. I don't want that. I want to get defensive, but not that defensive. All right, let's be real. So like if I wanted to buy one of these, like let's just do jets. I know my dad was wanting to buy jets. I don't know if he did. So would I try to time it? The answer is no. What I would do is try to find like a level to lean on, right? So with jets, for example, we've got this double bottom. You can see at the close right there, the double bottom from yesterday and today. It's up. Okay, so it's basically flat today. It's up 16 cents today. That's not a big deal. If I wanted to own jets, if I had already done my research and said I wanted to own jets, I'd probably just buy it. Okay. But if we're talking about an ETF that's up 5-10% on a given day, then I might try and wait for a pullback, find a level that you can lean on the dailies, on the daily chart. I hope that's what you mean, Swan Moon. Sebastian, turn this into an ETF show. That's what I'm doing, man. That's what I'm doing. But Swan, the other side of that coin though is if I look at ARKW. So okay, I screwed this up. Okay, I wanted to buy ARKW. I'll tell you when it first came on my radar. Probably in like the first half of 2019 is when I thought, I should own this ARKW. And I'd already gone through the ARK list and already looked at what I did and didn't want. And I didn't want any biotech, right? Because I'd rather own the IBB. I didn't want any biotech, so I threw out the ARKK, and I didn't really want. I just wanted growth tech, broad-based growth tech. I didn't want like fintech specifically. So this is the one that I wanted to buy, and I thought, but it's run up. It ran up in 2018. Let me wait. Let me wait for a pullback, like a real pullback, because I kind of missed that pullback, right? So let me wait for another one. And what ends up happening is all through the fall 2019, the winter 2020, it's going up, and I'm just sitting there and I'm like, what? I missed it. I'm an idiot. Why didn't I just buy this fund when I wanted to buy it? So this is me getting cute. I got cute here, and I was like, I'm gonna wait for a nice 10, 15, 20, 25% pullback, and I'm not buying the dip. Well, that dip never really came. Okay. So I missed it. So what I ended up doing is I ended up buying right there when things got crazy last March. That's when I bought it. Because at that point I was like, okay, I got my dip. Finally, I got my dip. I had to wait a year and a half or whatever, a year, but I got my dip. So the lesson there, if I can go back and do it again, I would have just bought it. That's the takeaway, is I would have just bought it. Will S. That's a better idea for the show. What the ETF? You know what? Will S. I actually might take that. I may take that. What the ETF? Randy, what do you think? What the ETF? Yeah, Will S. That's really good. I like it. That's really good. And then Hans Dickerson, that's the Oscar statue behind me that I happen to like. So I'm gonna keep it for now because it's Oscar season. So I screwed that up, right? I screwed that up because I could have been averaging in for another year. Instead, I just sat on my hands and got cute, waited for a pullback. So now here I am, right? a year later, I bought this thing right around there, right around like 50, like 55, somewhere around 55, mid 50s. I bought it, and it's been a great year. And now I'm in a situation where, okay, what do I do? Right? I'm sitting on some pretty big gains, not life changing gains. Again, this is my list of ETFs that I own, and what I didn't say is that 60% of my portfolio is these guys, the bottom two, right? VEU, VOO. That's 60% right there. All the rest make up like 5% each. Even though we're using ETFs, I'm still diversified. Okay, so that means I'm not going to hit any home runs in this account. I do have a YOLO account where I make YOLO trades. I gamble. That's not what this is for. Okay, not what this is for. So I'm in a position now where I'm sitting on some pretty big gains. Let's zoom out and go back to that chart. What do I do? So I like to identify what I call, or what everyone calls, the uncle point, right? The uncle point. Where do you say uncle? At what point do you say, screw it, I'm done, I can't take it anymore, I'm taking chips off the table? Because again, I bought ARKW. This is not a swing trade. This is a long-term play. Okay? So at what point would I call it quits? If I lost half my gains. That's the answer. If I lost half my gains, I'd call it quits. So basically, if ARK W fell to like 110, somewhere around 110. I'll be honest, I haven't done the math. But I know we got to 130 the other day or yesterday, or the other last week, but if it got to 110, I would think long and hard and probably take some chips off the table. Are there any costs involved with ETFs, BW? Yeah, there are costs involved in ETFs, right? The expense ratio, which we've got, I can go over that again, but the expense ratio is the fee that you're paying. And in most cases, not all, in most cases, your expense ratio will be rather low, right? Like you're paying less than 1%. You're way less. You're paying like for your cheapest ETFs, you're paying like expense ratios of like 0.02%, right, or 0.03%. Like I think SPY is like 0.05% or something, right? Ridiculously cheap. And that's pretty much the only, in most cases, that's the only fee you've got to worry about. You don't have to worry about load fees, which is a very common thing with mutual funds, or what's it called, the 12B1 fees, right? You don't got to worry about that. ETFs are just, they have fewer fees. That's one of the reasons why I like them. The other cost is your NAV premium, right? If your fund trades at a premium to NAV, tracking, they call that tracking error. You got to consider that, right? If your fund tracks an index and it sucks at it, right? It sucks at tracking the index. Consider that you're paying up. The tracking error is high. You're paying up for that basket. And then there's also the cost of getting in and getting out, right? The bid-ask spread. Those are really the three main costs as it pertains to ETFs. Okay. It is 2:37, and I want to pivot here to talk about this guy, BUZZ. Let's get this weekly off here. What's that about? Yeah, that's more like it. Buzz, the VanEck Vectors Social Sentiment ETF. This is interesting stuff because the timing of this, obviously, we are living in an influencer-led market, right? People like Dave Portnoy, people like Roaring Kitty, Zach Morris, God rest his soul, whatever happened to that guy? He's off Twitter. Influencer-led market, and this is basically a fund that tracks that, right? It's got a lot of math behind it that I don't understand, and we're going to ask Jamie about that math and how the algo actually works. But this is basically a way to trade social sentiment. We talk about social media providing alpha and insight and data and trading off that. You know, this is a way to trade that. This is a way to trade what is being discussed on social media. We're going to talk about what this fund is, what it is not, what it doesn't do, and how this index actually works. So Jamie Wise is our guest today. He is the founder of Buzz Indexes, president and CEO of Periscope Capital. And Jamie was on Pre-Market Prep back in like 2016 talking about this index. And it's come a long way since then. I think he may have even had to like retrain the index, right? Teach it new stuff. Teach it to measure more data points. Let's find out. I'm going to bring him on right now. Jamie Wise from where's my thing? Jamie Wise from Buzz Indexes. What's up, man? How we doing?
Hey, Spencer. How are you? Nice to see you.
Good to see you as well.
So I love that intro, by the way, of the preview that Benzinga got in 2016 to the Buzz Index. Yeah. It's been around this whole time.
Yeah. Okay, so let's talk about that, because the index, the methodology has been around. This isn't new. So can you tell us about how your index methodology, how it has changed, how the algo has changed over the last few years? Because I'm sure it's changed, right?
Not really. Well,
Not really.
Well, we'll differentiate between the index construction methodology and the algo behind that.
Sure.
Right? Because there's some changes within the algo naturally, but the index construction methodology has been the same since, when we first launched this index.
Right.
We first launched as a 25 name index back in December 2015. And then in August of 2016, it transitioned to a 75, broader, more diversified index. And the construction methodology has not changed at all since that point. And really, there's two key things when we think about constructing the index. The first is we determine an eligible list of large cap US equities that could get into the Buzz Index. And there's two key tests there. The first is the $5 billion minimum market cap threshold. And that's a fairly simple screen. And then the second test, which is more nuanced, is our proprietary measurement of those $5 billion market cap stocks with respect to the breadth and diversity and consistency of the conversation around those stocks. And we look back sort of over a rolling 4-quarter period to determine that. And the reason we do that is we want to identify sentiment shifts from a universe of stocks that are being talked about consistently day in, day out, regardless of news flow, regardless of an earnings release, those consistent conversation stocks. And that typically results in about an eligible universe each quarter of about 250 to 350 stocks. And then within each month of that quarter, we'll take that eligible universe and rank it from most positive sentiment to least, the top 75 stocks being featured in that monthly index rebalance.
Okay, so what goes into that sentiment score? Because that would seem to be the secret sauce, right?
The sentiment score is the secret sauce. That's the algorithm, right? And so what we've done for many years now is build our own tools. They're called natural language processing, which is sort of the branch of artificial intelligence that people refer to. But essentially, it's a model or it's an algorithm that is able to read text and understand the sentiment behind it. And what you'll find when you start looking at different natural language processing models is it's really all about how the models are trained. So a simple example, language translation, that is a natural language processing model. You can go into Google Translate, you can type in a word or a phrase or a sentence and choose one language to another. And behind the scenes, what's happening is a model that is, let's say, trained between Spanish and English has seen millions and millions and millions of examples of how language should be translated. And it's not just dictionary based, it's really based on experience so that it captures the essence of the translation. But that same natural language processing model can't understand sentiment around stock conversations, right? So our models had to be purposefully built to understand the language, the way people talk about stocks, the phrases they use. And when we talk about updating our models, one key thing that's happened over the last 5 years that we've been doing this is the use of emojis.
I was going to ask about that. What if I just put the thumbs up emoji next to hashtag GME?
The model will understand that now, right? Where 5 years ago when people were talking about stocks, there were very few people that included emojis. They were the early adopter conversationalists. But now that it's the broad community and we're comfortable talking about stocks, no different than we are our social lives and consumer products we engage with, emojis are a big part of the language or sort of the tweets and posts that are spread out across these online platforms. And the model needs to be trained to understand what they mean, because most consumer product reviews on Amazon won't have bears or rocket ships or things like that associated with them. But of course, in finance, they do.
Yeah. So, but what about just, I'm sure since you started, the conversation was mostly on places like really on Twitter and StockTwits, I would imagine. But now it would seem it's a little bit more diversified. It's much more, stocks are more mainstream. The retail audience has grown. So where are you pulling data from?
Yeah, I think those two sources that you mentioned, Twitter and StockTwits, are still the most important data sources to pull. It's sometimes romanticized that there's hundreds of these platforms where people are talking about stocks at scale, but they're really not. It's sort of like, there's a Facebook and there's an Instagram and there's a Twitter, and there's not 20 versions of those things. What we find in those communities is, that's where you really find the breadth and diversity of conversation, right? There are people on StockTwits that have a value lens from which they view the world, growth oriented, talking about all types of stocks, large cap stocks, small cap stocks, through technical analysis, fundamental analysis. So you get a real diverse community of people collecting there to share ideas. Where, you look at some of the other maybe offshoot forums and Reddit, we've always viewed as one of those. It's not nearly as diverse in terms of the number of stocks that people are talking about. It's always been sort of a polarizing kind of environment where, there's supercharged opinions about a very narrow focus group of stocks that are being discussed that day. So very different type of forum than what Buzz is trying to observe, which is, broad investor sentiment across the large cap US equities universe.
So I'm going to confess, I wanted to reach out to you a few months ago, but I never did, and I regret that, because I was really curious about your take about how the just retail activity has exploded in the market, and how that was impacting your index, because I'm sure in terms of volume, it went through the roof.
It did. When we started this, I think our models were processing around 2 million posts a month, which back then we felt was a lot of data. Now we're upwards of 20 million posts a month. And we've essentially seen a doubling of volume since COVID. And there's a lot of reasons why. People are home, they're focused on the stock market. They found these online platforms that they weren't aware of. Obviously, we've had, individuals like Dave Portnoy be the champion of that voice. And there's lots of individuals who are, engaged on social platforms, really connecting with a broader community. And so the amount of conversation has just really gone through the roof. But it hasn't slowed down, right? Even as, the economy reopens and people go back to work, the mobile apps of these platforms keep these people engaged, and we're not seeing any slips in volume of conversation. If anything, it continues to grow. That's been a huge help for the approach of Buzz. And generally what we see is over time, as message volume grows, the index's outperformance relative to a traditional benchmark like the S&P also grows. And it makes sense to us, because to the extent we have such a wider lens of what the community is doing, what they're talking about, more stocks being discussed, the aggregate collective conviction from that community, which is represented as the Buzz Index, becomes more representative of, the true sentiment shifts that are happening in the market, and has really led to wonderful outperformance over the last year and a half as that volume has really grown.
So how does this work? You have this index that you built basically and are supporting, and now you've got you're involved with Van Eck and Dave Portnoy. So who approaches who here?
Well, we've been in this ecosystem for a long time.
Right.
And we've known the folks over at Van Eck for a long time. And so they've been, looking at our index and thinking about it for a couple of years now, frankly. And I think what gave them confidence to ultimately license its use for an ETF were those factors that we saw transpiring throughout the year last year. The increased understanding of the broad investment community that, online social platforms are a thing, a little bit of a debunking of the myth that individual investors are sheep with no real intelligence or independent thought. We've long advocated that individual investors, are a lot smarter than people give them credit for. That's for sure. They do their homework, and this, you're part of the the social universe.
I'm also a retail investor.
Yeah, and so the research and the work that you do, and so none of that is really news to us. But I think the broader community is starting to pay more attention to it. And naturally, the performance of the index over time and having a 5-year track record also gave confidence that we could really analyze not just the approach. It's not really about the algorithm per se. I think it's really about the stock selection, right? That's what makes Buzz unique. When you look at the top holdings of Buzz, and we can look at it right now here, you've got DraftKings, Ford, Facebook, Twitter, and American Airlines. That's the current top 5, right? Since that rebalance. And find a long only manager or a hedge fund manager that has that kind of eclectic mix of holdings, where you see some value names, you see some growth names, you see all the reasons why the community collectively is positive towards these names. And you end up with this dynamic nature of the index, where it's not a pure style bet. It's not all momentum. It's not all value. It's sentiment, right? It is all positive sentiment. And that's something that's interesting, always been the most interesting part of the index to me. I think that's what resonated with Van Eck. And naturally, in terms of our relationship with Dave, he got it right away. In terms of how the internet is empowering people, how it's changing, how it's not going away, and how collectively, insights from the community would be the best way to potentially own large cap US equities. Here's Buzz with a track record to show.
So I've got the list of the holdings up. There is a name here that is missing, and that is GameStop. Can you explain? Yes. Can you explain why GameStop is not in the index?
So GameStop is a great use case to talk about. Remember, we start off by defining an eligible universe of stocks that could get into the index, and we do that quarterly. And so the last time we did that was January 1st, and when we looked at the first screen, which was give me all stocks that are greater than a $5 billion market cap, GameStop did not meet that list. And so right away, it's not eligible for the Buzz index and wouldn't be eligible for the next 3 rebalances. So not eligible for January, February, or I think it's next week we're going to be rebalancing.
Right. So that was my next question. So you rebalance monthly?
Monthly, yes.
So you rebalance monthly, maybe the weightings, but you
and the names. So from that eligible universe, let's say on January 1st, we determined there were 300 stocks that were eligible to potentially be included in the index.
Yeah.
Then for January, February, and March rebalance, we'll take that list and we'll again do a $5 billion screen on it, and then sort that list of 300 stocks, most to least. 75 are the index.
But theoretically, it could be included at the end of the quarter, right? Which is in a couple of weeks.
So when April will come around, what's going to happen then is we'll do another quarterly universe screen.
Yep.
And to the extent that GameStop is over 5 billion of market cap, it would be eligible. And then when it would come to the April rebalance, we would, use our analytics models to understand what the sentiment was, and is it high enough to be featured in the top 75 or not?
Question from SG in chat: is this considered actively managed? So the Buzz ETF, because it tracks an index, I guess that would be considered passive. But as far as the index itself, that's a rather active approach to an index, is it not?
It's an active representation of the community's convictions.
Yeah.
The index itself is a rules-based methodology. So no, by that standard, I would not define it as active, because we're taking the output of our algorithms and in a rules-based approach determining weightings. They're weighted by sentiment. The higher the sentiment, the higher the weight, capped at 3%. Right. And so all of those are rules encoded into the index. So from that lens, I would not think of it as an active strategy. But the security selection within the index very much feels like an active.
It feels active.
The portfolio manager is millions of people's collective buy lists, essentially.
Can I tell you my unfounded theory about Ford? Like Ford being on this list to me is like a massive outlier. Okay. My unfounded theory is that a lot of people who signed up for Robinhood got a free share of Ford. Back when Robinhood when that Robin Tracks website was out and that data was public. Yep. And they were tracking the most held stocks on the platform, Ford was like at the top of the list. And I could never figure out why until I heard it from like 3 different people who didn't know each other that they all got Ford as their free stock.
Okay. I mean, I don't know about that. That's an interesting story, but getting Ford as a free stock doesn't force you to talk about Ford. And
You're right.
What I know about the index is it's not looking at Robinhood or any other, individual investor holdings to determine positions in the index.
Yeah.
It's looking at the conversation that's happening around those stocks. And I don't know, maybe that free Ford stock opened up people's eyes, but they certainly talked about Ford a lot.
Yeah. Hey, what about the Open last week? You got, I think did Buzz set the record for most active Open?
Yes, it did. Yes. The ETF, again, which, is licensing our index. I can't really speak to the ETF, but
Sure.
It was the most actively traded day one ETF launch of all time. It was 450 million or around that number.
That's 400 million, 450. That's on the first day. That you never see that. That's right. Wild. That's wild. And I guess that would be appropriate then, right? Seeing as how that's the point. That's the point of the fund, is to track social sentiment.
The awareness of what we're doing now in Buzz is obviously greatly amplified by having Dave as part of our ownership group. Also having a great partner like Van Eck to really help raise awareness. Plus just the broad community's interest in what's happening across online platforms, makes it a natural talking point and certainly led to a lot of activity.
I think a lot of people were surprised to see Dave Portnoy get involved because ETFs it's like a very regulated industry, right? There's a lot that you are and are not allowed to say, especially before launch, right? There's a lot that you can't say. So what's that been like? Because he talks about Buzz every day.
Yeah, I mean, you have to just remember when that announcement from Dave came out, it was already public knowledge that the ETF was launching. So the NYSE had put out a press release the night before, and Van Eck had put out a press release the morning of. And so it was already in the public domain that the ETF was coming. And, as part of the ownership group of the index company, Dave is free to talk about the index and even refer to the index being licensed to Van Eck because it was public knowledge at the time.
Yeah. And he's like the influencer in chief, right? So I think a lot of people were excited because you don't see people, at least outside the typical Wall Street realm, of getting involved in ETF. So for people who are fans of the asset class, they were like, this is fantastic, right? Mm-hmm. Here we have a mainstream influencer. It's almost like when who did this? State Street. Remember when they got Elizabeth Banks to talk about mid caps a few years ago? Yeah. But this is that, but on steroids.
Well, this is very different because I think Dave is very transparent about when he decides to get involved in something, it's for the right reason. So Dave is not a hired spokesman like an Elizabeth Banks in respect to the Buzz Index. He strongly believes in the power of the internet, in the communities of people that are talking about stocks, into their collective intelligence. Yeah. It's a natural fit and something that he believes in. And that's why he's a part of this initiative and not in any way just, a marketing tool or a hired spokesman. If it didn't resonate with him personally, and if he didn't believe in the strategy and the index and the methodology, I can assure you he would not have been involved.
Question that I know the answer to, but I'll ask anyway. Is there a small cap Buzz index? That would be insane, I feel like.
I can't tip my hat yet to any new product developments, but you can imagine we've been at this for a long time. So we're constantly doing research on potential new indices.
Okay. And another one from Richard here in chat. How did you determine the expense ratio?
That's not up to us. We're just the index provider.
Oh, that's right. That's a question for Van Eck. I knew that, Richard. You got me. You boomed me. I asked it anyway. Yeah, it's a Van Eck question again. Jamie Wise, founder of Buzz Indexes, the brains, I think it's fair to say the brains behind the Buzz ETF that is licensed to Van Eck. That was pretty much the extent of my questions. Is there anything else you want people to know about how the indexes work, what it does, what it does not do, and maybe any common questions you've been getting in the past few weeks as you've been sort of making the rounds?
Yeah, I think the big one was, when you first hear the word Buzz, you think it might be some kind of meme Reddit-based ETF. And I think there's been a lot of discussion now over the last week. And, we've been clear. Dave has been super clear. Van Eck is out there. So I think it's well known to people now that the types of securities, types of stocks that get into the index are these, large cap US equities that are being talked about in broad and diverse ways and not focused on any kind of short-term trading strategy. I think the monthly index rebalance is important. When you think of sentiment, you can think about it from different lenses of time. short-term sentiment being much more volatile than longer-term sentiment.
Yep.
And what this index does not try and capture are those immediate short-term moves because an earnings release happened or a person of influence had said something, and the stocks have a short-term reaction to that. This is measuring longer-term trends in sentiment and momentum changes of sentiment, and that's really what you can get through the index.
And what's interesting too is like the universe can change. Like right now, obviously, it's a lot of if I go back to the top holdings, it's like nope, right there. Like you see a lot of tech, obviously, right? Because people talk about tech. But if for whatever reason, utility stocks become like the hottest thing to talk about on Twitter, then that will be reflected in the fund, in the index, and then the fund.
Yeah. There is no sector constraints in the fund. So the
Right.
sector exposure of the fund is a byproduct of sentiment. And that's what we think is really exciting and makes it so dynamic, is its ability to shift holdings and sector exposures as market environments potentially shift. Or on the other hand, to see through that, right? So we've seen this time and again where, you get a correction in a certain sector. Everyone in the financial press is really negative about it. It's the end of the world, but we don't see sentiment changing and sentiment stays strong. That gives, me at least the conviction that it's still the right sector to be in or the right stock to be in, because I can measure through the online discussion that on balance, people are still very positive toward it. We see that in chip makers would be a great example. They've had a terrific run over the years.
Yes.
Lots of pullbacks, lots of people saying things like they're overvalued. And you look at an AMD or an NVIDIA, and it absolutely was the right trade to stay invested. And I think, the index was generally invested throughout that entire time period, supported by the data of the community of people that really never wavered in their sentiments. It was really fascinating to see.
All right, Jamie Wise is the founder of Buzz Indexes, and the Buzz ETF is now open for trade with one of the I would say like in the top 1% of tickers out there, BUZZ. It's in that upper echelon of tickers that are appropriate and also roll off the tongue and easy to remember. The three key factors for a ticker. Jamie, thank you so much for the time today. Appreciate it.
You bet. Thanks for having me on. Nice speaking.
All right. Let's just wrap this up. I'm going to get to one question, though, first from chat that I'm just seeing here. Scott Jeffries, can the price of an ETF go up independently of the way the underlying stocks that it holds go? Yes. This happens all the time, every day. This is called ETF arbitrage. A couple of things to note about this. This is a trading strategy, right? Dennis does, if you listen to Pre-Market Prep, Dennis does this every day. So what he'll do is he'll look at SPY, right? And he'll see, okay, SPY is up 0.5% this morning. And then he'll look at like the top 10, which make up a large, I don't know what it is now, but it's the top 10 make up a lot of the SPY. I think that's like 35%. If I'm wrong, someone correct me. And he'll say, okay, well, looking at the top 10, looking at Apple, looking at Facebook, Netflix, Google, looking at all these top 10 stocks, I see that they're all up like 2%, right? They're all up a lot. And the S&P is only up like 0.5%. Therefore, the rest of the index, the other 490 stocks, give or take, should trade down. They should correct. It has to offset, right? The math has to work. So he'll short those stocks, right? He'll short those stocks, saying that's how they should trade. The other thing is, I think maybe what you're referring to more is if during the day the price gets out of whack. Okay, so when that happens, this is sort of where like the middlemen come in, right? So someone who's called an authorized participant in AP, what they do is they see, oh man, okay, like the ETF, the basket's going way up, but the stocks that it holds are not going way up. So what they'll do is they'll buy all the stocks, right? They'll just go into the market and they'll just start buying stocks. And then they'll go to the issuer and say, hey, issuer, hey, Van Eck, right? Hey, Vanguard, I've got all these stocks. Let me just exchange them for shares of your fund. And that brings the balance, that brings it in, right? That's the and they profit off that, right? And so that's how the price is kept in line. The ETF may go above and may go below the stocks in the basket, but if that happens every time, the APs will come in and just like let's say if the ETF is trading at a discount, they'll come in and then they'll buy up shares of the ETF, and they'll swap those shares for all the individual. They'll go into the market and swap them for individual stocks. So the APs will come in and keep that price in line. I hope that was a simple explanation for and that's how ETFs stay. That's how the NAV stays in line. It's 302, 303. Crap. I have to get off here because we've got first trade up now. Rohan, is that true? I think that's true. All right. First trade is supposed to start right now. I'm going to hop off. I will see y'all at 3:30 in about 27 minutes. Guys, hit that like button. Thank you very much for hanging out with me. I appreciate that. Thanks to Jamie Wise as well. Smash the like. Tell your friends. And I very well may take the suggestion to change the name of the show to What the ETF, because that is fantastic. Everyone, I'll see you at the close. Or for the closing show in a half hour, first trade or first trade's up now.